What's up, guys? It's Minwin with What's a Mortgage. Tonight, we're going to talk about something that loan officers don't want to talk about: their commission. My name is Minwin. I will be your host. Thank you for tuning in to our channel called What's a Mortgage. Our goal on What's a Mortgage is to educate, train, and empower you for home ownership. If you'd like to find out more about home ownership, don't forget, check me out on Facebook Monday through Thursday at 9 p.m. I do a live stream that you will love, 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 love. So tonight, with all the information I'm giving, if you like the information, give me the thumbs up. Don't forget to hit the subscribe button so you can see all the videos when they do come out on your YouTube channel, guys. If you're watching on Facebook, turn your notifications on, right? Don't forget, leave the comments below if you have questions, and I'll help you answer your questions, guys. All right? So tonight, we're going to talk about loan officer commission. How do loan officers make their money? And we're going to talk about, again, the institutions, the 4 different lending institutions, and how all the LOs make their money, right? Every institution is different, and all depends on, some institution has a nationwide compensation plan. Some of them depends on if it's outside lead, inside lead. It all depends. So tonight we're going to break that down. We're also going to talk about how commission works, how institution pays their loan officer, and number 3, lender credit. How do you get a credit, right? Because once the loan officer gets paid, if there is extra money or if you increase the interest rate, you can use that money towards your closing costs. Buying a home is very expensive. I like when you buy your first home, right, you try to get as much credit as possible between the seller and interest rate, because most likely you're going to move or sell between 5 or 7 years. Why tie up all of your own money in 5 or 7 years? The interest is not going to change that much, but your monthly payment will change. Your out-of-pocket changes drastically when you come out of pocket to buy your first home. Here we go, how commissions work. There's 2 ways loan officers get paid. The 2 ways loan officer gets paid is they get paid with a flat fee or something called basis points. Flat fee or basis points. So when you call in, when you hear that on the radio, some people still listen to the radio, or you call on an advertisement, most likely like Cash Call, Loan Depot, Guaranteed Rate, those mailers that you call in from, right? So a lot of lenders, they have these little mailers. They look like they're from the government, but they're not, right? And you open them and you call in. A lot of those places pay their loan officers on commission. So when they pay commission, or online lenders, right? If you go to Bankrate, you go to a lot of these companies that sell leads to these mortgage companies, the loan officers who work for these mortgage companies, right, get paid a salary, a base, or draw, or they either do a draw base until they hit their commission. These loan officers will close about 20, 30, maybe 20, 30 loans a month, but they get flat for fee. What's good about that? The lenders have low fees because they're paying flat commissions to their loan officer. You'll get the rates, but you might not get the service, because that loan officer is trying to close 20, 30 transaction, about a couple $100 a file. So, they're trying to take in as much as they can. So sometimes I think they're great for refinancing, try to keep it 100 with you guys. Places that pay loan officers flat commission, great place to do refinancing, right? Because it's flat fee, the fees are lower, the rates are lower. So a lot of times they're great. But for purchases, when it's your first investment, you don't want to be just a number. You want to be the main focus of that loan officer, main focus of that lender, because you don't own the home yet. You can fall out of escrow. There could be hiccups. You can lose your deposit. There's so much that can happen. So when it's a flat fee lending institution that pays LO's flat fee, I am kind of leery of that for purchases. For refinance, there's a lot of positive to it, unless you do have a complicating file, then you're just a name, you're just a number. But right now, refinances have dwindled down a little bit, so a lot of these flat fees are not available. Most loan officers that work at places do not want a flat fee. They want basis points. What's basis points? We'll talk about that next. So when they get paid basis points, right, they get a percentage of the commission based on loan amount. Normally, basis points is about 1/10 of a point. That's 1 basis point. 50 basis points is 0.5%. 100 basis points is 1%. 150 basis points is 1.5%. 200 basis points is 2%. Why is that important? Because if the loan officer is making 2%, That means on a $400,000 loan amount, he's making $8,000. Another loan officer that has that the purchase price is say $400,000, but if his comp plan is 100 basis points, then he makes $4,000. What's the difference? So they're matching rate for rate. You can tell the guy who makes 100 basis points, his rate a lot of times can be more competitive than the guy that makes 200 basis points. But that's not always the case, and we'll talk about that in just 1 second. Hopefully, you guys understand now how loan officers make their money. They're going to make between 40 to 50 basis points, depending. A flat fee, right? It could be like $500 a file, $800 a file. Of course, if they have a higher flat fee, the rate's probably going to be higher. Most places are paying like about $400 or $500 a file, but they're funding 20 units. So that's about $8. And a loan officer that gets paid flat fee makes about $8,000, or probably bonuses and all that stuff too, right? So you're getting paid that, or it's 40 basis points to 400 basis points, right? So if that loan officer or that branch is making 400 basis points, guess who's paying for it? You. And now let's go into the different comp plan. So, well, which institution pays what, man? I thought about you would probably think that, so I thought what you thought, so I thought to write it down, right? Or I thought to make an infograph about it. So here we go. The different comp plans. You have your depository banks. You have your mortgage banks. You have your direct lenders. You have your brokers. So we're going to go from depository banks all the way to broker. So at a depository bank, Wells Fargo, Bank of America, Chase, U.S. Bank, Union Bank, credit unions, right? Most loan officers are going to be on a draw or salary plus basis points. So what ranges from 40 basis points to 90 basis points. So on a $100,000 loan, that loan officer would make $400 if they're on 40 basis points. If they're on 90 basis points, they'll make $900. So with depository banks, if the loan officer works for the depository bank and he's an in-house loan officer, guess what? He's going to make a 40 basis points. That means that person who's sitting in the bank on a day-to-day basis makes 40 basis points. So when you walk in, they make around 40, 50 basis points because the lead, they call you the lead, the consumer, already walked in. The brand, the name sells, so they're paying loan officers less, right? The guy who works in the bank probably has to fund that much more, but he gets a chance to because he's sitting there waiting for opportunity. The loan officer who works for these depository banks, but they have to go out and get their business, they make about 90 basis points up to 100. Majority of these depository banks make between probably 75 basis points. For every 100,000, they make $7,500, right? $750, not 7,500, $750, right? So that's how depository banks work. So because there's something called, with depository banks, there's something called, or with how lending works, these big banks, there's nationwide comp plans, right? Most of these loan officers, they're going to be, so the guy who makes, well, if the guy gets paid 40 basis points, is his interest rate going to be better than the guy who makes 90 basis points? The fact with depository banks, they cannot do that. So nationwide, there's a nationwide rate for them. There's a nationwide, so if they're going to have everything at 90 basis points, just the guy who works in the branch gets paid 40. So the 50 basis points will go back to the lending institution or the depository banks, right? If the 40 guy, the guy who does 40, doesn't make the guy as much as the guy who makes 90, right? So that's how depository banks pays their loan officers. Because they pay them so low, right, because the brand sells, most of the times, not all, their rates are really good. Why is that? They're paying 40 to 90 basis points. They're paying a lot less from the other lending institutions, and we're gonna go over the other ones, right? So a lot of times when you go in there, unless you got to pay attention, if the bank took an L the first 3 quarters, the 4th quarter, the loan officer's comp plans didn't change, but they might have to raise the rate and keep more money to get back in the black. So pay attention to that. It happens a lot with Wells Fargo because they're always in trouble for something, so they got to make up their money somehow. So even though their loan officers might not get paid a lot, but their rates might be higher. That's why it's really good to pay attention if the banks took any hits throughout the year before you go ahead and do that. Especially in credit unions, right? The loan officers barely make pennies, but their rates are low, their fees are low, but their guidelines are strict. If you have a squeak in your wheel, that's no bueno. You don't want to mess with that because they're already paying loan officers less. They're already giving you a great deal. They got to make sure you're squeaky clean. So the next lending institution we're going to talk about is mortgage banks. Mortgage banks, the loan officer makes between 200 basis points to 400 basis points. Rarely do you see a 400 basis points. The reason why I put 400 basis points in there is because they probably belong to the mortgage banks, sometimes they belong to a branch. Some mortgage banks have this branch model. Some of them don't. The ones that don't have the branch model, the mortgage banks keeps all the money and the loan officer makes 200 basis points. So if the branch comp plan is 400 basis points, the LO makes 200 basis points, the branch would make another 200 basis points. Out of their 200 basis points, they probably have to pay employee taxes, underwriters, doctors, funders. So that's why their rates seem kind of high. Also why their rates seem kind of high, because they're also have to pad enough money to pay their regional manager, the recruiter, the area manager, the West Coast, East Coast divisional manager, and then there's the nationwide managers. So a lot of times with mortgage banks, they're in the mortgage business, right? They'll take a little bit more of the not squeaky clean loans, but you're gonna pay a charge for it, right? So it can be 200 to 400 basis points. Same thing with direct lenders. Direct lenders, though, a lot of times there's not all these guys on top, so their rates have a chance to be better, right? So about mortgage bankers and direct lenders, I like them if you're gonna go down payment assistance. Why is that? They're gonna slam that deal through. They don't make as much, no matter if you use a direct lender or a broker. If it's a down payment assistance loan, all the rates are the same because the money that was supposed to go to their commission goes to the consumer for their down payment. That's why they have to charge fees in front to make that money. So that's how mortgage banks and direct lenders work. So be careful that when you go see a mortgage bank or direct lender, hey, are you part of a big branch? Because they are, and they have a heavy pad. Guess who that affects? You, the consumer, right? So how to look for them. If you go into a real estate office and they have lenders in there, most likely those lenders will be mortgage banks. And if they're mortgage banks or these high-end direct lenders, they have that branch margin, right? And then the pad is there to help cover costs, like the rent of that office. That's how mortgage banks and direct lenders operate. A lot of times direct lenders, though, they don't have these big branches. So when they don't, the compensation is a lot lower. It can go from 150 to 200, right? But I gave you a number so you can kind of see what they make, and we're going to go through at the end on how to understand it. Hopefully, guys, all this makes sense to you on how basis points work. The last one we're going to talk about, mortgage brokers. Mortgage brokers, there's no branches. You know, they make between 100 basis points to 300 basis points. And how mortgage brokers work is they have different deals going with every different wholesale bank. This one wholesale bank, they might be on 100 basis points comp plan. Other one might be at 1.5, 2, 2.75, 3%. I've seen 3%, I've seen 2.75. The reason why I like mortgage brokers, I'm not a mortgage broker, so I'm not steering it. I'm just giving you the information based on the knowledge that I have on these institutions, right? With brokers, they can compete more against direct lenders, mortgage banks, and depositories sometimes, is because they can shop your loan. Of course, if direct lenders and mortgage bankers are making 300 basis points, guess what? Why would they do a loan for 100 basis points? They'll do it for 2.5, save you a little bit of money. But, you know, if you're willing to pay 3 at the mortgage bank, 4 at the mortgage bank, they're going to try to make 3. You'll still get a better deal, but they're not trying to go, okay, let me do it at 100 basis points and knock it out of the park for you. But brokers, there's a lot more flexibility. Direct lenders have a little bit of flexibility. Mortgage banks don't have so much when it comes to the rate, right? That's why they try to avoid the rate as much as possible. We had one of our WAMFAM buyers, they actually called Rocket Mortgage. And the guy was actually a guy on the phone, which is kind of rare. Like I said, he took an inbound call on the phone, and he was selling some insane rate because there's so many hands in the cookie jar. That's the reason why, right? Not all lenders do the same thing. Rocket Mortgage is Quicken. But I know if you call Quicken, which is another department, their rates are a little bit different because it's how they advertise. So it depends on, you know, the lending institution, how they advertise, which advertisement did you call in on. That's what will decide rate. So this is my scale, my MinWin certified cost, right? Here we go. I think if you're going to go from a most affordable to the highest paid, it's going to be depository banks, mortgage brokers, direct lenders, and mortgage banks. But remember, direct lenders and mortgage bankers are a real estate agent's best friend because they get the job done. So if it's your first investment and your deal's kind of quirky, you want to go with a direct lender or mortgage bank because they get the job done, but they're paying their loan officers, their branch margins are higher. Hopefully you understand that, so you understand, hey, you know what, I'm paying a premium, but I'm going to get her done, right? You want to get her done? Direct lenders, mortgage bank. Brokers are going to have more flexibility, but they don't have the control like direct lenders and mortgage banks do. Depository banks, a lot more conservative. There's no squeaky wheel, right? Because they don't make enough. And they're trying to give you the best deal. So if you want the best deal and you have no squeaky wheel, depository banks is the way to go because their fees are low, their rates are low. But don't forget, if you have issues with your loan, sometimes they might not be the best. Cheapest, lowest rate might not be the best because they might not get her done. If you want to get her done, you might want to go with a direct lender or mortgage bank. Brokers kind of like that person in the middle because they don't have their own staff the way depository, direct lenders, and mortgage banks do. So it's like playing the telephone game. You know, I like them because of flexibility. They do more different programs, right? Sometimes these direct lenders, mortgage banks, and depository banks, they only have a handful of the main programs. But if you're going to go non-QM, stated, construction loans, ITIN numbers, all these crazy things, broker is going to be able to find a wholesaler that will do the loan. Hopefully that makes sense to you guys. So now let's look at rates. Here we go at rates. The reason why I want to look at rates, I want to go over lender credit with you guys. Here's an FHA rate, right? Let me show you these FHA rates here. Listen, boom, 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 boom. I'm waiting for the monitor. I'm on the slow side. So look right here. Here's an FHA loan, and here's a VA loan. So let's look at FHA, right? Look at the rate. It says 4%. If it says 4%, and that loan officer's comp plan is 1%, and you lock it on a 15-day lock, don't forget, look at that 4%. At 4%, the bank or the compensation is 2.583%. That's 258 basis points. If the loan officer's comp plan is 100 basis points, that means 1.5% will go back to you, the consumer, as closing costs. So if I work at a place, you cannot take these rates as face value because there's also risk adjustments. I'm just using this as numbers. So caution to you, I'm not quoting rates. I'm not quoting anything. I'm just showing you a rate sheet, breaking it down so you understand. So today, this was my rate sheet, and my comp plan was 100 basis points, right? If I sold 4%, you, the consumer, would get 150 and 83 basis points back towards your closing costs. But check this out. If I work at a lending institution where the branch margin is 4%, I would have to sell you a 4.5% interest rate, and you would get 0.253 lender credit. Hopefully that makes sense to you. So if the branch margin was 3%, I would have to sell you 4.25, and you would get a 0.417 lender credit. So once you meet the comp plan, the difference of the money after 2013 rule was released, the money must go back to the consumer for closing costs. So depending on your LO, where he works, if he's part of a branch, if he's part of a team, depending on what their margins are, that will decide. So that there is a big difference. If you're a VA, right? Think about if the loan officer's comp plan is 2%. If today I had to sell 2%, 4.125 on the VA, which is the right side right there, 4.125 would pay me 2%. 0.767 would go to you towards your lender credit. If I work at a branch where 4% breaks is my branch margin, I would have to sell you 4.5%, and 0.053 would go towards your lender credit. So definitely, guys, where the loan officer works makes a big deal. So there's something now, it's called margin compression. Because of people like me and because of the internet and everyone's battling for their clients, these margins are tightening up. Places that were making 4% margins are making 3 or 2% margins, right? So a lot of these upper echelon wigs of these mortgage banks are slowly becoming sales guys again, or they're losing their job, or they're being let go because the banks can't afford to pay up the top anymore because margins being compressed. Because before they would get away with 4%, now they can only get away with 3% or 2%, which, you know, big wigs salaries and all that, they got to get cut out. So as the market's evolving and changing, I want to show that to you. I think eventually that's going to be compressed where, you know, rates are more similar. Right now, it's not the luck of the draw. It's the what lender did you pick? And where is he in his company? Is he part of a big branch? Is he just working directly with corporate? It all depends. Is he an inside LO or an outside LO? Is he working at a call center? So all these things do make a difference. Hopefully you understand now and you see the difference between loan officers. So we just looked at government loans. Let's look at conventional loans. Conventional loans, so a lot of times when they set branch margins, it's like a nationwide branch margin thing, right? So let's say if the branch is in California, there's a branch in Arizona, their margins should be the same. So normally with government margins, it's always about 3 to 4% as the branch built in. The LO might make 1.5, or 100, 150 basis points, but the branch might make 300, 400. Here's conventional, right? Here's a high balance conventional loan, right? So let's say if it's conventional, normally the branch margin might be 3%. So at 4.75, it would break even. Oh no, there would be 0.196 to the buyer for lender credit, right? But if you went below that, the buyer would have to come in the difference because the branch margin cannot change. The reason why these rules came out where the margins can't change, no matter what rate the LO gives you, his comp plan stays the same except for brokering, because that comp plan with that broker will stay the same with that wholesalers they're signed up with, so they can keep changing wholesalers so their rates can change. But direct lenders, mortgage bankers, and brick and mortar, their rates, no matter what rate they give you, their pay stays the same. That's changed in the market because of all the with all the CFPB, right? They were saying that, hey, it's unfair that because you can get away with charging a lower income client more money, you're able to do so. If you're gonna make 3 or 4% on a poor person, you got to make 3 or 4% on a rich person. It's not what you can get away with. That changed. That's why people, the market's going to crash. They came up with so many of these rules to protect you, the consumer, from all these things happening, right? Well, how they're protecting us, they're going 3, 4%. Well, if their branch margin is 3, 4%, guess what? Nationwide is 3, 4%. That means there's people throughout the nation paying that comp plan. It's not what they charge, it's what you have agreed to pay. If you don't like it, find another lender. That's all you can do. But a lot of times when they have to match it, they need proof that you got a quote from another lender, and a lot of times they have to back off their margin because they don't want to lose the deal. But if they already backed off too many files, they're not going to back off anymore. So a lot of times when the loan amounts are small, like $200,000, $300,000, they might not back off the margin because they're saving it for a $500,000, $600,000 loan amount. Like, hey, it's a big loan amount, let me back off the margin because we'll make something instead of nothing. We'll make it up with the lower loan amounts, right? But a lot of times they can't just, let me go ahead and do so. They need documentation from the consumer that they got a quote from another lender with that rate and with that lender credit before the direct lenders or the mortgage bankers or the brick and mortar companies, right? This institution decides to back off on their margin. So hopefully that helped you out. That helped you understand. That gives you the confidence when you're shopping with a different loan officer. You might not like what I say if you're a loan officer watching this, but times are changing. Margins are being compressed. Make sure you're on the right side of the fence. You know what side I'm on? I'm on the consumer side. I'm on the Wham Fam side, baby. So, guys, if you like this information, please hit the subscribe button or the notification button. If you'd like to see more videos, go ahead, check me out live Monday, Tuesday, Wednesday, Thursday on Facebook. I go live every day, Monday through Thursday at 9 p.m. My goal is to educate, train, and empower you on home ownership. Thank you guys so much. If you have questions, leave a comment below in the description, and I'll reach out and I'll answer your question, guys. This is Min Min. Peace out.